All right. Good morning, everyone. Thank y'all for joining us today. I am Kate. I'm the CSA Director of Events and Education. We put on our workshops, our in-person workshops, roundtables, and conferences. And then throughout the year, we also do some informative webinars. One of those today, we have Stratus Business Advisors joining us. Sam is with us to present, and Amanda is in the background to answer some questions too. I'm not going to take up any more time. Sam, I'm going to turn it over to you. We'll go through the presentation. If anybody here has questions, feel free to use a little chat bubble. I'll be monitoring that and I can pop in and ask some questions. So, Sam, all yours.
Yeah, thanks, Kate, and thanks everybody for showing up here on a Thursday morning. We'll keep this to about 20 minutes of prepared remarks because we know everybody's busy and I'm sure there are lots of questions. But yeah, feel free through the chat to throw some questions in there. And you're all here, right? This isn't a typical presentation. So if you want to jump on and make a comment, feel free to do so. But yeah, we're going to talk about kind of the merits of what has been put in there and how it impacts you all. So that's really the goal today is this is a very good from a business owner standpoint. I think that it's a net positive for folks. And we were just Karen and Kate and I were just talking that something had to happen to really help because sunsetting this makes it very difficult to plan, as you all know, as business owners. So let's jump in here. The first thing I will say is that we're business advisors. We're not CPAs. We're going to talk about some strategies. Tax is a really important thing that we deal with all the time. But this is something that you need to discuss with your accountant. We're happy to give you some ideas and some thoughts, but ultimately go back, talk to your accountants, figure out how this is going to impact you, because each company is going to be slightly different depending on where you are in a fixed asset cycle, what kind of products you're selling. So just reminder of that as we move forward here. So we're going to hit 8 areas. So 8 big areas here that we're going to talk about. All of them I think are very good, very positive. And some of these areas will be better for workers, employees. Some will be better for the business owner, and some will be good for both. So it's good to know both sides because I'm sure that you'll have employees who are curious, right? Asking questions about stuff like overtime and what happens there. We'll get into these tax-free accounts for minors towards the end, which is what's being called the Trump account. I think that can be a very useful thing for both the business and for your employees. So income tax rates remain where they are. Right, top bracket stayed at 37%, did not go back up to 39%. That's a marginal bracket. Standard deduction was increased. And this is just the standard deduction for folks under 65. Remember that there's an additional standard deduction that can be taken for folks over 65. And so this is going to be interesting to see how it works. I think a lot more people will end up not itemizing. And there are some benefits though. And one of them that we're going to talk to you all a little bit here right now is that even if you don't itemize, even if you go ahead and take the standard deduction, there are certain things, right? There's a charitable contribution, $2,000 you can take as a married filing jointly that if you don't itemize, you can still take that up to $2,000. For your employees, a big thing to keep in mind is about that overtime, right? That overtime piece is important, right? It's $12,500 that's potential that they can deduct. Starts phasing out at $150,000 for individuals, $300,000 for married filing jointly. This should hit squarely for a lot of employees. But that deduction, right? That overtime deduction is going to be allowed even if you take the standard deductions, or even if you're not itemizing. So a couple things in there that will allow you to even accelerate that standard deduction a little bit more. So definitely things to think about here. The one thing to remember, and as if you're talking to employees, if they have questions, that overtime, right? No tax on overtime, no tax on tips. That's through 2028. Okay, so that will not continue unless Congress steps in and does something at that point. So just to keep in mind as you're talking about this. So things to think about. pass through. A lot of folks are either an S corporation, an LLC, potentially LLC taxed as an S corporation. Everything comes through that individual return. So think about, do you need to place new equipment in service, right? Is this something that you can do to reduce that taxable income? All right, because the other thing that this did was it expanded the size of some of the brackets, particularly in the middle of the distribution of the income tax bracket distribution. So it may be that you can get and stay in a lower bracket where you weren't able to before. If you're a C corporation, no change at all, right? 21%, it stayed 21%. We'll talk a little bit later about the QBI, the qualified business income that they kept in there, so that if you are not a C corporation, your tax rates would be closer to that 21% on an effective rate. This idea of a cash balance plan, this is something that we're floating out there, and something for a lot of folks to think about. Look at your cash flow. This is in addition to a retirement plan where you can put away a lot more dollars. And so we've got clients who, right? So right now it's what, about 23,500 for folks under 50 that you can put into a 401k, plus an additional 7,500 if you're over 50. And then there's a new provision for people in the 60 to 63 age range that is 11,500. But even adding all that together, a cash balance plan, we have clients that are putting away 150, 160, 170,000 pre-tax dollars into this cash balance plan. Could be an interesting move here to move profits into a tax deferred vehicle and reduce your current taxable income. The other thing to think about, depending where you are in your life cycle, is the idea of Roth conversions, right? With wider income tax brackets that are set up to adjust as inflation with inflation, you may find if you're an owner and you're starting to wind down and you're not working as much, maybe you're selling off some of the business, you don't have as much income, you may end up in a lower tax bracket, and you may be able to take some money from a pre-tax account like a 401k, pay taxes on it now in a lower bracket, and stick it in that Roth. The nice thing about a Roth is it grows tax-free. You've already paid taxes on it, and there are no distribution requirements. So this can be a really good way to build up cash or tax-free assets for either your use and particularly for your heirs' use. So some things to think about here on the income tax side. All right, here's a big one. This idea of state and local tax deduction. Now it's not going to impact you all as much as it would if you were living in New York or New Jersey, but the cap was increased, right? It was 10,000. It's been up to 40,000. This again is another one that's going to phase out. If nothing is done, it's going to go back to $10,000 in 2030. The big thing to remember here is this last bullet. That pass-through entity tax is not limited. So they did not limit your ability to use your pass-through entity to pay some of these state and local taxes. And property taxes could be a big one, right? And this could be personal too, as well as business. So use that cap, right? 10,000 to 40,000. This could be a potential thing that's really useful. And so think about how the business can be used. Talk to your accountant. How can the business be used to pay these state and local taxes? And then the timing is going to become important, especially as we get to 2029. Are there ways that you can pull taxes from 2030 into 2029 to take advantage of that higher cap, which will adjust for inflation over time?
On your federal, but if it went over $10,000.
Anybody out there here's some, is that a question, or are you all right? All right, we'll keep going here. Itemized deductions, right? We talked earlier about standard deduction, right? Itemized deduction, this is gonna be important in two ways. Number one, this 199A pass-through is not touched, right? And we'll get to that a little bit later. I think the big thing here to think about in itemized deductions are the fact that it used to be a percentage of adjusted gross income, right? That would be what you could deduct if you were in that top tax bracket. Now it's a cap. It's a straight dollar cap. 35-cent tax benefit per $1 deduction. So that may limit, depending on where you fall. This is something you may want to talk to your accountant about. Is there a way you can potentially get out of that top tax bracket to take advantage of these itemized deductions without the cap? And then again, getting back to that idea of charitable contributions, deduction for overtime pay, these are things that you don't have to itemize to be able to take advantage of. But again, this is something that you want to look either side, right? Run those calculations, talk to your accountant, encourage your employees, if they work with an accountant, to run both sides. If they don't, encourage them to run both sides through a program, TurboTax or something like that. See which one is much more beneficial for you. I think that's the big takeaway here, is see which one is more beneficial. We talked about comparing standard and itemized. Timing, again, is going to be really important. And timing of the deductions is going to be important here, because when this goes into effect is January 1 of 2026, right? This new cap on the top rate. And so can you pull more stuff into 2025? And this also includes charitable. And if you're in the top tax bracket, can you accelerate, and you're a charitable, somebody that likes to do charitable giving, can you accelerate some of those gifts into 2025 when you're not in that dollar for dollar tax deduction, right? The cap there. And that may give you a little bit of a boost on your 2025 taxes. So certainly some things to think about there. So here's a big one, and this is a big one for long-term planning. We were going to, prior to this bill, there was going to be a sunset of this increased estate and gift tax exemption. Right here, we're talking about the lifetime exemption. It was going to be cut in half starting January 1 of 26. That has not happened. The exemption will actually increase to a flat 15 and 30 million, depending on if you're individual, married, filing jointly, respectively. So that will be good, and it's going to start adjusting for inflation in 27. There is no expiration date included. They did not include a sunset like they did in the 2017 tax bill. This is a really good planning opportunity for folks. With this higher deduction, with this higher exemption, excuse me, and with no expiration, it makes it a little bit easier to plan. There isn't that scramble to, oh my gosh, we have to get things in before the sunset happens. And so there are kind of two sides to this, right? It's, thank goodness, more folks probably are not going to run into the estate or gift tax exemption right now. However, and I'll give you a quick example. We had a client of ours come to us, business, they own the real estate, and they have some other assets, some liquid assets, 401ks, brokerage accounts. Totaled about $24-25 million was the value of the estate. Phew, we're set, right? $30 million, we're married filing jointly, we should be fine. Well, the reason that you want to get these assets valued every 2 to 3 years is because in the case of this business, if the value of their business and the value of their real estate was increasing at 10 to 12% on average over the past decade, at that rate, within 4 years, they would be subject again to this estate tax. All right, and that's 40%, right? Anything above that estate tax is a 40% tax, right? So if you end up with an estate that's 35 million and the estate tax exemption plus inflation, let's say, is 31 million, that's $4 million. 40% of that is $1.6 million. That's a lot of money. And that's money that is going to have to be paid if somebody dies. And it's particularly difficult when you're a business and real estate owner, because you can't just go to the business and sell $1.6 million worth of assets, right? It's different than having a brokerage account that's got $20 million in it, right? A little bit easier to come up with that money. So really think and know what your business is worth, know what the real estate is worth, and know how they're growing, right? The final thing I'll say here on this one is discounts. Take advantage of those discounts. Another example for you. We have a client who is a co-owner of a business. He's the majority owner. he wanted to put away some money, move it outside of his estate, and provide ongoing income for his wife if anything could happen. Something like a spousal lifetime access trust. We were able to make a gift into that spousal lifetime access trust. We were able to use discounts for lack of control because it was a minority stake and lack of marketability. Those really can reduce, right? It was about a 20% lack of control discount, a 15% lack of marketability discount. If you're talking about $1 million, let's say that the interest was worth, right? 20% is going to be 800,000. We take, another 15% off that 800,000, right? And now we're talking some real money here, right? Let's see, what would that be? That would be 120,000 more dollars. So, $680,000 that you're gifting as opposed to $1 million. That makes a difference. And every penny counts here. So just think about these things, and it's things to have in the back of your mind as you're planning longer term. All right, this QBI, the deduction remains at 20% and there's no expiration date. I think that's really what the big takeaway here is that there's no expiration date. So again, makes it a lot easier to plan if you're an S corporation or an LLC. Deduction again was put in to help businesses that are not C corporations pay an effective tax rate that would be closer to that 21%. So again, look at your entity structure, look at your tax structure. How does this QBI play in? Well, a big part of it is going to be compensation, salary, bonuses, that goes into it. Work with your accountant. How can you set this up to maximize what you're getting from QBI? Right? That's the real way to do it. And this deduction can be worked to your advantage, and it can be done with some planning. And now would be a good time to have that discussion. All right, a big one here, right? Everybody knows that starting in 2017, you had this 100%, you were able to depreciate 100% upfront of property. That then started to reduce, right, by 20% a year. That has now gone back to 100% for anything that was put into service as of January 19th of this year. Okay? 100% on that bonus depreciation. The expensing, right, what's called Section 179, that was also increased to $2.5 million of qualifying property. With the Section 179, the key there, though, is that there's a cap. Above $4 million, you have a dollar for dollar deduction in the amount you can expense. So if you put in service $4.1 million of equipment and you wanted to expense that, you would only be able to expense about take $100,000 off, right? So you could expense 2.4 million instead of 2.5. Bonus depreciation, there's no limit. And you can expense as much as you want. The other big difference between the two, and we can look kind of here at what you can do. One of the big differences between the two, right? Bonus depreciation versus expensing, you can't expense yourself to a loss. If I'm reporting $1 million of income and I put in $1.5 million of property into service, I can't take in 1.5 million and expense the whole thing under Section 179, right? Because I'm going to end up with a $500,000 loss. I can expense 100,000 and I can carry forward 500,000, but I can't expense myself to a loss. Not the same with depreciation, right? So again, a conversation to have with your accountant. And from a strategy standpoint, what do you need? Do you have an aging fleet? Are you thinking about an upgrade to software? Are you thinking about putting in an e-commerce website? Do you need to do improvements to property? What are the things that will really benefit your business? What are the good investments you can make in your business? Because now those investments will come with a tax benefit. And it's just a question of, do I use 179, right? The expensing. And in our opinion, expensing can be really good, especially on longer life property type assets and things like a new roof, right? These are things that you usually can't put under a Section 168 accelerated 100% depreciation. You can do it under Section 169. Section 168 tends to be better shorter life assets. trucks, forklifts, things like that, right? Racks, those types of things. So look around, where do you need to make that investment? And then know that there'll be a tax benefit to it, and sit down and have that conversation with your accountant. Just a quick note here for everybody. This is not a direct impact, but something that may come up if you're talking to customers. One of the things that this bill did was it did provide a boost to that low income housing tax credit. And 9% was the allocation. There's a 12% increase to that allocation beginning in 26. I think that will be useful. There'll be more dollars in the state to use towards housing. This idea of this private activity bond, that threshold was lowered so that these tax exempt private activity bonds, you only needed to hit a 25% instead of a 50% threshold to get the financing. Both of these things should result in more houses being built, more renovations being done. This last study down here that we've seen a couple things come out from different groups, but building and restoration potentially of over 1 million affordable homes over a decade. It's not going to put a huge dent into what we need to build, but it's at least a start. And so we would encourage you to just know in the back of your head that this is out here, that a lot of your customers are going to be looking potentially to get low-income housing tax credits, and how they can work with that. And knowing that there's more money, easier financing can be a good way to do it. And also talk to chambers of commerce and housing finance agencies. These are the folks that are actually going to be involved in how this money is allocated and who gets it. So knowing about this could be really, really beneficial, especially depending on where you're located. Last thing here we'll look at, and then we'll open it up for some questions, is this idea of these Trump accounts, right? And this is kind of a neat addition to the law. This is for folks who are under 18. So another savings vehicle. This is not a 529, right? So it doesn't have the same restrictions as a college savings account. It's an IRA, so it's pre-tax dollars. Contributions can be made starting next year, right? The starting of the contributions is a year from when the bill was signed, so July 26. Individuals under 18, $5,000 maximum. They cannot make distributions until they turn 18. The interesting thing here, and I think one of the things for everybody here to think about, is does it make sense from a business perspective if you know that you have folks in your workforce who have young families or who are starting a family? Employer contributions can be made. It's a deduction just like it would be if you made a contribution to an IRA or a 401k. It won't be included in that employee's income. So if you put $2,000 away, that could really help somebody and help their kids, but it's not going to increase the tax burden on the employee, and it's a pre-tax contribution for the employer. So thinking through some of these things could be a good way, especially as we're talking about issues with recruiting and retention in the industry. Just another tool we potentially have in the toolkit here. And of course, employees can do this on their own, right? I mean, they can set this up. They don't need the employer to do it. The employer just has the option to put some money away. And again, these accounts can be a really good way to build up some money, whether it's an additional educational expense that may be outside of the purview of a 529, or eventually part of a down payment for a home. This could really be a good financial bedrock for young families trying to do the right thing for their children. So where do you go from here? 100% meet with your accountant if you haven't done so already. This is a great time of year to do that planning. There's enough time towards the end of the year where you can actually think through some of this stuff. Make sure you have current appraisals of your business and your property. Really, really important. Okay, because those tend to grow faster than the rate of inflation. And so we want to be prepared, because eventually, especially if you're somebody that owns business and property, you're probably going to end up bumping up against that estate tax or breaching it at some point in the future. Discuss the tax benefits with your employees. We talked about that on the last slide. Could be a great way to give them some incentive to provide a really lifelong benefit for their children. and then work with your customers as you all do. Helping your customers to figure out how to be more profitable, how to get more business is a great way to again retain and build relationships. So being proactive, I think, is super important. So we're here to help, right? We do all our business valuations in-house. We specialize in this industry and do a lot of develop and implementing succession plans. And then, of course, we have to think through the tax and risk mitigation strategies. This bill is a big part of it. And from our perspective, as I said up top, I think this is a net positive to business owners and will be a good thing ultimately for the industry going forward. So with that, we'll open it up for any questions. Thank you for your attention this morning. I appreciate it.
Sam,
Yeah.
this is Jay Short down in Tifton, Georgia.
Hey, Jane.
The bonus depreciation that you cannot take yourself into a negative. I mean, we've just built a new door shop and we've got a pretty heavy investment going, so we should have a lot of write-offs there. The bonus you can't take into a negative, the Section 179, are you able to take the Section 179 into a negative?
Yeah, good question, Jay. It's the opposite. You can't take the 179 into a negative, but you can the bonus depreciation.
Okay. All right. One other question. You mentioned the like new software and stuff like that. I know Georgia has a research and development tax credit, and there's also a federal research development tax credit. I think you can take 6% of that research and development, whatever the costs were, and it's dollar for dollar federal side. Can that go into a negative?
That's an excellent question. I do believe it can, but I'll double check on that, Jay, and I'll get back to you. I'll shoot you an email later today.
Okay.
Good questions. Thank you. And feel free to put stuff in the chat too if you all have anything pressing, and here's my contact information. Shoot me an email and if stuff comes up as well. But Karen or Kate, did you all have anything else you wanted to touch on here?
Can you just clarify permanent? Many of the provisions are permanent versus sunset, just so everybody's clear what that means.
Yeah, good point, Karen. So a provision that's set to sunset is typically done because of budget rules, right, or reconciliation rules, and it's done so that there won't be an increase potentially in the actual deficit spending. But when something is made permanent, basically there's no expiration to it, and that's better for planning. Now, of course, permanent is only as permanent as whatever Congress is willing to do. I think that's the flip side of that. But for now,
law to change it, right?
Say that
Yes,
again?
they would have to
It
take
takes a
action.
voted in law to change it.
Yeah, exactly. And I think that would be, that's really the key, is that once these things are put into place, it's very hard and would be, in my opinion, and I'd be interested to hear your thoughts, Karen, but would be very politically challenging for them to walk back some of this stuff, especially because it is such a benefit to businesses.
Yeah, that's right. Then I have one other question. Can you talk a little bit about trust within a trust?
Yeah, and this goes back to that piece on the estate side. And I'll give you a good example. So when you set up a trust, you can put a number of different provisions in it. And one from my own family. So my grandparents set up a trust. My dad's oldest brother has autism. And within that trust, once the second to decease of my grandparents, once my grandmother died, most of the money that didn't go to paying estate taxes was then put in a sub special needs trust for the benefit of my uncle. And that has been there to help with his care since then. And so this idea of a trust within a trust is a really neat way for you when you're doing your estate planning to be able to pick out specific beneficiaries or causes that you care about and have money directed there even if you're not around anymore. And so the whole idea of building a trust within a trust is that we can continue to keep this money protected and also under some of your your goals and some of your considerations even after you're no longer alive.
Sam, this is Jay again.
Yeah.
You mentioned on the pass-throughs with the SALT deduction, it's going from 10 to 40.
Yeah.
And if I'm able to say, I want to have I got a personal office at my house, and I
Yep.
want to lease it back to one of the LLCs or one of the pass-throughs. I should be in that pass through. If I do a triple net lease, would be able to pay the taxes on it and deduct the taxes if it went beyond on the property taxes and all, if on all the properties, if they went beyond that 40%. Correct? I mean 40,000.
Yeah, exactly. And that's the good thing, Jay, about having multiple different entities is depending on what you're doing with the entities, they can be used to take advantage of the exemption in different ways. So yeah, that could work, and that's a great idea with a home office like that to lease it back.
Yeah. Okay.
Any
And
other
then
questions?
one other thing on the Trump account.
Yeah.
When you go into the Trump account, we've got a standard 401k, and
Yep.
it's got a Roth provision, and we can put money in Roth, or we can put money in in the regular standard 401k. That if we were to look at setting up the Trump account type thing, would that be something that our 401k provider could provide to track that, or is that something we'd have to do out on the side in a separate program? And what additional cost would we have of anybody that's doing that?
Yeah, good question, Jay. So my understanding, and the rules on these ones are still being written, especially because they don't go into, you won't be able to start them until July of next year.
Right.
But my understanding is that these are more akin to IRA accounts. And so these are going to have to be set up by individuals first. And then the business can come in and make contributions to them on
So
their
our
own.
employees, basically, if we wanted to do something like that, the employees would have to come in and set that account up.
Yeah, exactly. There was something that was floated about potentially folks who were born, next year would automatically have an account set up for them in 2026 and going forward. But nothing's been decided on that. But as far as I know, Jay, this is not something that's going to run through a 401k plan. And so the only cost to you all as employers would be whatever contribution you're willing to make to an
Right.
employee's account for their children.
Now, is that,
Okay.
I'm sorry,
then
go ahead, Jay.
Yeah, I had one other thing on the 401k Roth situation you mentioned.
Mhm.
If we're able to show with the extra investments that we've done this year and able to get dramatically lower our tax bracket, like on our personal side, if
Yep.
through our 401k, converting, what is the cost to convert that regular IRA, regular 401k over to the Roth side?
Yeah, good question. So it's going to be added to your ordinary income. So if you had $100,000 of income and then you wanted to do a $50,000 of a Roth conversion, you'd report another 50. So you'd have $150,000 of income. So
Okay.
that's why it's really important, Jay, to think about where you're going to end up tax bracket wise, so that you don't end up bumping into higher tax brackets and paying money that you don't want. You might as well just leave it in the pre-tax account at that point.
Right. Okay. Good question. Appreciate it.
Yeah, absolutely. Brent, did you have something?
Well, back to the Trump IRA.
Yeah.
If you contribute for one employee, do you have to contribute for all qualifying employees?
Not that I know of. It's not like a 401k or a SEP IRA where once you make that contribution, or that match, you're set and you got to do it for
So
everyone.
if one of your employees was your children and you wanted to contribute to your grandchildren that way?
Absolutely. That would be absolutely okay to do in my opinion.
Okay.
Double check
Okay,
it with your
that's all.
accountant though.
Yeah, exactly.
Damn,
Because they're still writing the
Dan said so.
rules. They really are still writing the rules for those Trump accounts. The other thing for CSA dealers that I will try to get our accounting firm, Symphona, to do is maybe a one-pager on the provisions around overtime, et cetera. That would be something you could, in layman's terms, that you could maybe distribute to employees. So I'll reach out to them this afternoon to see if they might be able to help us with that. That way everybody doesn't have to scramble to try to tell their employees individually. We can help you with that.
Well,
Yeah, when I explain to my employees it's above the line, I kind of get a blank stare. on
Right.
them.
well, that doesn't go into effect till January, correct? The overtime exemption?
No, it should go back for this tax
It
year.
goes back for this tax year,
Yeah.
correct?
Okay.
So I'll work on that with Symphona and see if they've got something.
Appreciate
Yeah, good
it, guys.
idea. That's a good idea, Karen.
All right. Any more questions, folks?
I'm good. Thank you very much.
Yeah, thank you all. Appreciate it.
Sam, you guys are great. You and Amanda are super partners for us here at CSA. We really appreciate it.
Yeah, we love working with you all as well. So yeah, if anybody has any questions, reach out to us, but definitely get in touch with your accountant, as Karen said. That's the first place to start.
All right.
Thanks,
Thanks,
Bob.
folks.
Have a good day.
Appreciate you.
Thank you, Sam.
Absolutely. Take care, guys.
Bye now.